This is Sovrun, your guide to financial literacy. Today we're exposing the hidden cost that eats your commodity ETFs alive. In 2024, oil rallied over 30%. But if you held the most popular oil ETF, you only made 12. Where did the rest go? It vanished into something called roll yield. And most investors have no idea it's happening. Roll yield is the profit or loss a futures-based ETF generates every time it sells an expiring contract and buys the next one at a different price. Think of it like running on a treadmill that's tilted slightly backward. You might be sprinting at full speed, but because the belt is moving against you, your actual progress is much slower. That invisible drag, that's negative roll yield. Here's how to calculate it. Roll yield percent equals P near minus P next, all divided by P near. P near is the current contract price. P next is the next month's price. Let's use oil as an example. The near month contract is $75. Next month is 78. So 75 minus 78 gives us negative 3. Divide by 75 and you get negative 4%. That means every single month you lose 4% just to stay in the same position. Now here's where it gets ugly. Over 5 years, natural gas spot only fell 12%. But the UNG natural gas ETF, down 88%. Oil spot gained 34%, but USO, the oil ETF, gained just 12%. The gap between the asset and the ETF is roll yield eating your returns. The United States Natural Gas Fund, UNG, is the poster child for roll decay. Between 2007 and 2023, while natural gas had multiple massive rallies, UNG lost over 99% of its value. Every single month for over a decade, it was forced to buy more expensive contracts. The spot price went up and down, but the ETF only went one direction. Here's the misconception. Most people think if oil goes from 70 to 80, their oil ETF goes up the same amount. It doesn't. Most commodity ETFs don't own physical barrels. They own paper contracts that expire. In a contango market, time is the enemy of the ETF holder. And roll costs aren't just in commodities. They show up in software licensing when you upgrade at a premium, in insurance as the cost of maintaining a policy you hope never to use, and in real estate when you roll a bridge loan into a higher rate mortgage. Follow Sovrun for more financial insights.